Hello, today is the 2nd of August 2011, and what a wild day today. Although, when you look at the weekly chart, it may not look like much is happening. We're still only 2 days into the week thus far, but this was a day where the shorts got slaughtered on the precious metals, and they did fairly well within the major indices and oil and so many other things, as it was mainly bonds and precious metals where currency was going into. The debt ceiling was, in fact, raised today. And it was interesting because this was one of the days where I decided to watch a little bit of the mainstream and CNBC. And I wanted to see how volatile the gold and silver markets as well as the major indices would be as Obama was speaking and as the announcement came on the vote. And then I seen, okay, the votes passed through, and I'm looking at the gold market, and it pretty much stayed around plus $20 for the day at that time. Silver was hovering around 39, really didn't do anything, showing that not always when these big news events happen does the volatility go with it. On the quarter day chart, or the 6 hour, with each candle representing 6 hours in time, the market's again going above and below this level. At some point, it has to stop the neutrality. And as I said earlier today, the longer you're in a range, the bigger the breakout or breakdown tends to be. It's going to be big to getting above really 41 and even 41 and a half. It's interesting how this upper band is really hovering in or around the 42 area, which is that big level of resistance that I'd be expecting it to go to. Now, however, when you see levels like this, Fibonacci says it's supposed to go to 42. When you manage to have a move pretty close to it on 41.33, then that's only about a 2.5% break above this level. So very often you could expect it to, if it finds resistance, to at least pierce above it most of the time, that is. And today was an interesting day because the stock market was just getting hammered over close to 300 points, down 265 for the day. The NASDAQ was down 75, oil down to 93.30. The S&P was down 33 points, so it was very volatile. When we take a look at this chart with the Dow Jones priced in silver, we can see it's pretty much went from breaking the support level here around 298 down to about 292. And that's about a 2-3% move. And what I find interesting about this is that you have this big candle, which is a break below this range in here, and then it follows up immediately with another big, large candle. And this is a 25-minute chart, and this takes it going back for the last 4 days. If you want to know which day each one is, there's 47 ticks. So basically, here ends a day, pretty much around here, and somewhere around here. But overall, the stock market did get hit pretty big. It did take out some technical indicators, but I'm really not focusing too much on the stock market today. Now, over the weekend, I was, however, showing this chart, and as you can see, we have this level of support here, roughly at around 270 or so. And with the gold market today, the amount of money or the amount of gain that it was that silver had over gold was under 2%, or 2 times, I should say. This represents how silver did today versus gold. Therefore, for most of the day, silver was roughly around the 1.6, 1.7 area for how much it outperformed the price of gold. And normally when silver goes up, it usually does better than 2%. And that was mentioned earlier on the video, and I guess that's bad news, but this comes from a perma bear as well. And when you look at this move, you got to say, well, why was it not two times or more? Because whenever silver gains 2% or greater, at least over the last few years, going back to sometime in 2009, it's 78% of the time when silver goes up 2%, that they beat gold with at least twice the gain. Now that means that 22% of the time that it doesn't. So that tells us that it doesn't happen every time. And while I have this chart on here, and I like to show these trends on natural charts that aren't traded, this being one of them, these people have asked me why these parallel lines work so well. I can't answer you that too well, but they just do. Because if you put these together, this is what you get. Nice trend channel for this market. But for previous days when gold pretty much didn't do as bad as silver, or at least anywhere below 2, we'll go through them, but before I do, gold has never yet, at least since 2009, had a better percentage gain when silver goes up 2%. I'll look more later on. I can get data back to 2006, I think, with the SLV, but for now, it doesn't do it too often. So anyway, now let's move forward to the daily chart. And within this, we're going to take a look at some of the previous days in which silver gained over 2%, but gold held in there or basically stayed less than 2. And what's interesting is this is the 6th time since October of last year that in the first week of the month that we had this happen. So the last one was April 5th. April 5th would bring us somewhere in here. Well, that turned out to be a good buying opportunity for that one. And then before that, it was February, early February, which turned out to be in here. Before that, it turned out to be December, November, the last 3 months of last year, which meant in here, it meant in here, and then it meant somewhere in here. So we see this before. The trend doesn't say this reverses a trend. Merely it tells us that gold did pretty well. And a lot of times when this happens, it's usually one of two things. It's usually either the added pressure to gold. Gold got significant pressure that it normally doesn't get to the upside for, or it's extra added short exposure, selling exposure to the silver market. My guess is it's added exposure to the gold market. Now, as far as this chart is concerned, it's holding well, and it's showing a little bit of a bull flag, which really emphasizes how big this break is and really how much this does have the potential to explode, because it was in this long range and now we're in this long range. So we're really in two different long ranges. When we come back to 50, this will be at least the fourth test, excuse me, of the 50, because you had a test in here, you had a test here, and you had a test back in 1980, at least one of them. Therefore, you've had 3 tests. Will be coming up to the 4th. The more often a big support or resistance level is tested, the greater the chances are that it takes it out. The 50-day moving average is it's holding in there. It hasn't even come back to it, and it doesn't have to. Even if it does, that's bullish. A sell-off towards this orange line can both be bearish and bullish. The only way it would be bullish is if it does bounce from that level, and then sometime later on it breaks through those highs and, of course, makes it more towards the upside. The Fibonacci level at around the $33 area was amazing support, as was this level here from this high to this low. And that's why I'm saying the 42 level is significant. Breaking 42, then the next key level would be the $50 one that I'm talking about. Thank you for tuning in for today's episode, and take care.